It is possible to borrow money against the value of your crypto, but there are many things to consider, and so I'll go over all of that in this video. The main way of doing this is putting a crypto asset onto a platform, and you have a value there, and then you borrow stable coins against it. So USDT or USDC are the main ones. There's a few others, but essentially borrowing dollar stable coins against crypto. That's really the main bulk of what the market is right now. So there are many things to consider here, including the risks of the platforms. Are you using centralized or decentralized platforms? How do they work? What's the interest rate? What's the payback? And everything like that. So firstly, we'll go over some of the terms here if you are new to borrowing against crypto. So we press borrow now on Binance. I'll just show you this. Essentially, you have a collateral that you have to put on to borrow against. So whether that be Bitcoin or ETH or any of the other supported assets, you have a value there that you have, right? You put that on, and then that's the thing that you borrow against. You borrow the stable coins against. So that's your collateral. Then you borrow an asset against it. Mostly it's going to be stable coins. And then you have what's called a loan to value. So think of it like a mortgage where you are given a loan against the value of a property, right? So that's your collateral. The property is a collateral. Well, it's the same with crypto. You have a value of your collateral, and then you have a loan against it. So LTV is loan to value of the collateral that you have on the system. So if you put $1,000 worth of Bitcoin onto the system, you have that as collateral to borrow against. The loan is just what percentage of that $1,000 are you borrowing, right? So if you're borrowing $100, then your loan to value is 10%. If you're borrowing $500, your loan to value is 50%, and $800 would be 80% loan to value. With the vast majority of crypto lending and borrowing right now, most of it is over collateralized lending. That means that you actually have to put more collateral on the platform than you can borrow in dollars against it. So if you have $1,000 of Bitcoin, you cannot borrow $5,000 against it, or 4 or 3 or 2 or even 1. You're going to, for the most part, be allowed to borrow around 80% or probably closer to 75% of the value of your collateral. So if you have $1,000 of Bitcoin, you can probably borrow at a maximum $750 of stable coins against it. The reason being is, like I said, over collateralized lending is a safety net for the platform. So what I'm going to be showing you is platforms that only use over collateralized lending, because these platforms aren't actually giving you a loan, right? These are not banks. Banks create money, create credit to give to us. That's not crypto platforms. These are not banks, right? And so they can't create credit. It's not fractional reserve banking. This is simply a market for lending and borrowing. And so the platform has to have this buffer to liquidate your collateral if it falls in value versus your loan. And so that's what the loan to value is. It's over collateralized, because let's say they give you up to 80% loan to value. You can borrow $800 against your $1,000 collateral. But crypto is super volatile, right? So that $1,000 can easily fall 20%. Now you've got $800 collateral versus $800 loan. That's not great for everyone, right? Because someone's going to get hurt if your collateral falls under your loan and you can't pay it back. So what happens is you get this buffer, right? 20% buffer. And if the collateral value falls anywhere near your loan value, they're just going to liquidate your collateral, right? So if you have Bitcoin on here, they'll just start selling the Bitcoin to pay back the loan. And that's how it works. So this loan to value is about max 80%, but a little bit under that. And then as you can see here, the margin call comes at around 85% loan to value, which is literally an email or like an alert that says, hey, your collateral is falling in value and your loan is 85% of the value of your collateral. That's not great. Please put more collateral on to reduce the loan as a percentage of your collateral. And then as you can see, liquidation here, 91%. Basically, if the loan is 91% of your collateral, they will start selling down your collateral to reduce your loan. So they don't want a bad debt, because Binance isn't giving a loan, and over collateralized lending, you shouldn't be basically taking money from the platform, right? They should not be giving you loans, because these crypto platforms are not banks, right? So it's actually a market for basically people on the other side who want to earn interest from you, who are putting their assets on the platform and putting it into the earn platform. So they're earning basically, right, getting your loan and getting the interest from your loan, right, when you pay it back. And then you're the other side taking that loan, Binance aren't doing this, or the crypto platform shouldn't be doing this. It should be basically a free market here. So that is liquidation, loan to value, and how it actually works with over-collateralized lending. There's two different ways we can take crypto loans. One is variable and one is fixed. Variable meaning variable interest rate and variable time horizon. Essentially, think of a big pool of money, and there's lenders and borrowers, and the pool sets the interest rate based on supply and demand over time. So you can put money in, you can pay off the loan immediately, you can take a bigger loan, you can pay off some of the loan whenever you want. Everything's variable. Now the interest rate's variable because it's just supply and demand of lenders and borrowers. So if you have loads of people wanting to borrow dollars, that means there's a shortage of dollars, the interest rate goes up. If you have loads of people putting dollars in to earn interest rates from borrowers, then you have a supply of dollars and the interest rate goes down because there's a big supply. And so this can change over time. And it's a variable interest rate. So something to be aware of if you are going ahead and borrowing dollars in variable interest rates is that they can change wildly. So for right now, the rate to borrow dollars on Binance is 13.26%. But again, that can go down, that can go up. In bull markets, you get more borrowers. And so interest rates go up. In bear markets, that may come down a little bit. But if you have assets in here and you're borrowing against them, the rate is variable. So you have to be aware of that. Usually you get an APY, so an annualized rate, but the interest may be charged hourly or by the minute or by the second. It depends on the platform. But in any case, just look at the APY. So that's something to be aware of. Now you can also go with fixed rate loans. So I'll show you this one. This is a fixed rate, fixed time horizon, fixed amount. So basically you're just meeting up with a borrower and a lender at exactly that time and saying, these are the terms that we agree to, and that's that. This is not variable. Everything is fixed here. Most DeFi platforms won't allow this because this is having to meet with a buyer and a seller of debt, basically, right? And so most DeFi platforms will be a lending pool just because of the way smart contracts work. But if you can get fixed rate loans, you can also fix these if you want as well. But fixed and variable are the two ways to go ahead and carry out a loan. There are many lending and borrowing platforms out there. In this example, I'm just going to show you Aave. So if you go to DeFi Llama and then come down to TVL, you can see Aave is really the gold standard in lending platforms. It's the number 2 by total value locked. That's the amount of value that people are lending and borrowing on the platform and have on there, 21 billion, as you can see. Now, there are some other platforms out there. You may use them. You can find them here if you want to use them. But by far and away, Aave is just like absolute gold standard number 1 that you'll just use, right? So you can borrow a lot of assets on here and lend and borrow. And this is DeFi. When it comes to CeFi, things get a little bit different, right? So we're going to go to transparency here. And these are crypto trading platforms which may offer crypto loans. Again, I'm going to show you Binance as it's the number 1. It's been around for a while. It's absolutely huge in terms of the amount of assets here. But still, there are risks. The difference between CeFi and DeFi. When you put your assets on a centralized platform, they actually gain title of those assets, which means you're giving title over to the platform. Now, what that means is they're not your assets anymore. Now, you can withdraw them and they let you withdraw them, no problem. They're your assets again, right? If you put them into your wallet that you own, they're your property again. But we've seen a lot with centralized platforms is they blow up or they go bankrupt or something else. And your assets that you thought were yours are not yours anymore. They're now tied up in bankruptcy, Chapter 11, Chapter 7. You still have the loan, right? So you still have the contract for the loan that has to be sorted out. But now your crypto assets aren't yours. You can't liquidate them because they're actually the property of the bankruptcy estate. It is a complete and total nightmare. That's the thing with crypto loans is, putting them on a centralized platform can be a massive nightmare, and you have to do massive due diligence to know that the platform that you're putting them on, if you're using a centralized exchange or a centralized actor in any way, you have to be super, super sure that they're actually going to, maintain their solvency as a business as well. So I can't vouch for any of these, but it's a massive, massive risk. And we've seen previously FTX and Celsius and some others, some others that weren't even doing any, nefarious stuff. They got dragged down and they went bankrupt. And so client funds were on there. That is CeFi for you. And unfortunately, that's a big, big risk. So you have to use really top exchanges. And if you really trust an exchange or a lending platform or anything, then that's fine. But you never really know with CeFi. Now with DeFi, you don't have that issue. With DeFi, all of your assets are yours, right? You keep custody of them. And a protocol should not go bust or bankrupt because it's a smart contract on a blockchain. And so again, I would just only use the top DeFi protocols because with DeFi, you don't have that risk. But what you do have is smart contract risk, rug risk, hacking risk, everything like that. So these are the risks you have to be aware of when doing this, right? Bitcoin in your hardware wallet is no credit risk, right? No platform risk. As soon as you start using platforms, there are risks here. Just be aware of it before getting into anything. And I don't want to vouch for any of these platforms. Now I'll show you how to take a crypto loan on a centralized platform and then a decentralized platform. So I'll use Binance here because I've used them before. I've also used Bybit. I'll leave links below to both Binance and Bybit and some other exchanges I use. You might be able to get deposit bonuses if you're new on there. You can see the details below. But I'll press borrow now. So in Binance loans, all we have to do is put an amount of collateral in the system. So let's say I put 1 BNB here. On the right hand side, you can choose many different collateral assets. Another risk here is that the collateral that you put on, this is crypto collateral that you're borrowing against. Crypto is notoriously massively volatile, right? 50 to 60% volatility is kind of like normal. So if you're taking a loan of 80% loan to value, it's probably 100% certain that you are going to get liquidated at some point if you're, not paying off that loan and reducing the loan to value. So in terms of loan to value, I would go super, super low because otherwise you're going to get liquidated. Right now you may think, well, I basically sold the crypto at that point and I've got the dollars, so I don't really care. That's all up to you. But just to say that crypto is massively volatile. And if you're taking a high loan to value, you have a very, very high chance of getting liquidated and getting your crypto sold away from you, right? So that's up to the individual managing that and knowing the risk and the volatility of these assets, right? So I'm just going to take a $50 loan against 1 BNB and the current loan to value is 7%, right? So I'm pretty good. And you can see the interest rate, 13% here. The interest rate is because that's the interest rate for borrowing dollars. If you borrow a different asset, it's going to be a different interest rate. But it literally is simple as start borrowing and that's it, right? So I've now got that $50 loan and that's in there. You can see my orders, my ongoing orders. The BNB is collateral. You can use Bitcoin or ETH or whatever else. And then that is the amount of debt. And you can see that I've got interest racked up already on that I will have to pay back. Now on Binance, all you have to do is just press adjust LTV or repay. If you want to adjust LTV, you can basically take a bigger loan, move up the loan to value or pay it off, move down the loan to value. I'm going to repay. And then right here, it says, what do you want to pay in? You can pay off the loan and everything with crypto collateral if you want. They'll just exchange the collateral into the USDT that you have to pay back, but you have to pay back USDT because that's what you borrowed. So you can either liquidate other assets to pay back the USDT, or if you have more USDT in your account, you can just pay that back yourself. So I'm going to press max here, make sure that we've done that, and then confirm repayment, and that's it, it's out. So that was a loan. And I paid back the loan plus the interest. I had some USDT in my account, so no issue. So take the loan. Now, with the loan on Binance, you have that stablecoin in your account. Because they have a collateral on the system to pay for the loan, that means you can do anything that you want with the USDT. So I loaned that USDT. I could cash it out. I could send it to a DeFi platform. I could cash it out into a bank. And do anything I want with it because I've got the collateral on the system that Binance can use to pay it back anyway. So you can do anything you want with that cash. Taking a stablecoin loan from a DeFi app is the exact same thing. It's just that this dApp exists on a blockchain. So we need a crypto wallet and we need funds in the crypto wallet on the chain that we want to use. And then we can connect our wallet to this dApp. So this is Aave, which is an Ethereum-based app. So Ethereum mainnet and all of the other EVM chains. You can see all these chains here. These are called different markets, but they're just different blockchains. So for Base, which is Coinbase's layer 2, you can see USD coin market, 11.81% is the borrow rate for USDC. If we go over to Core, which is Ethereum mainnet, you've got Tether market at 9.73%. USDC is 13% to borrow. If we go over to a different one like Arbitrum, USDC is 11% and Tether is 11.5%, right? So choose the market that you want, right? So I'm going to choose Base. And what I'm going to do is connect my wallet. Now, if you don't have a wallet and you don't know how to use them, videos below on getting set up with wallets and what the best wallets are for various different chains. I'm going to connect wallet here. I've got a Rabby wallet, so I'm just going to connect. It says, what do you want to do? I'm going to connect browser wallet here and just connect my Rabby, and then it's connected up here. You can see that. So I've got the wallet downloaded. It's in my browser. I've just connected it to Aave, and then it's going to read my balances in the wallet, and I can go ahead and use Aave very easily. If we want to borrow stablecoins on Aave, we first need to put some collateral on Aave to borrow against. Now, because Aave is an Ethereum app, most Ethereum apps are going to use ETH as the collateral on their system to borrow against. So what I'm going to do is go over to my wallet. This is my Rabby wallet. I'm going to copy my wallet address, and then I'm going to send some ETH into my wallet address. I'm going to use ETH as collateral to borrow against. And so I want some ETH in my wallet to send into Aave. And I also need to pay for gas fees on all of the transactions that I do on a blockchain. And so for Base Network, they have ETH for gas. For Ethereum, it's ETH for gas. For Optimism and Arbitrum, it's ETH for gas. Other layer ones may be a bit different. But we've got our wallet set up and we need to send some ETH into our wallet first to pay for gas and then to use as collateral. So I'm going to paste in my wallet address. It says which network do you want to use. I'm using Base, so I'm going to choose Base here. And then I'm going to withdraw an amount of ETH over to my Base network. Now, if you don't know how to do that, tutorial guides below on setting up wallets and how to get money in and out of them. Once you learn, it's pretty easy. If you're looking to take a stablecoin loan against Bitcoin using DeFi, you have to jump through another hoop. Bitcoin exists on the Bitcoin blockchain and it can't be taken off there. If you want to take a loan against it using CeFi, you just send the Bitcoin into their wallet, take the dollar loan against it and pay it off and then withdraw the Bitcoin back. Now, if you're using Aave or an Ethereum dApp or a Solana dApp, those are different blockchains and Bitcoin does not exist there. So how do you use Bitcoin as collateral then? Well, what has been invented is wrapped versions of Bitcoin. So this is how it works. Coinbase has an amount of Bitcoin. They issue IOUs on Ethereum that match 1-for-1 the amount of Bitcoin that they hold, right? So they have $1 billion of Bitcoin in a wallet. They issue $1 billion of wrapped Bitcoin IOUs on Ethereum. The value should be 1-for-1, right? Because these IOUs on Ethereum can be redeemed 1-for-1 with the actual Bitcoin that Coinbase hold in their own wallet. But it's not Bitcoin, right? You can see this right here. CBETH is Coinbase wrapped Bitcoin. That is, Coinbase have Bitcoin in their wallet. They've issued this token on Ethereum, which is an IOU, which because people trust Coinbase to have that Bitcoin, should have the exact same value as the Bitcoin itself. So that's how you use Bitcoin as collateral on DeFi. You have to use a wrapped version of it. CBBTC is Coinbase's wrapped Bitcoin. There's also other versions like wrapped Bitcoin, but there are different trust assumptions, right? Wrapped Bitcoin is going through something where the owners are changing a little bit, and that means you have to trust them to not do anything or lose the keys or anything like that. More risk involved, right? So if you're looking to borrow against BTC, try and find a wrapped Bitcoin that you trust and you think is okay. But what you have to do is take your Bitcoin, send it into Coinbase, and then withdraw it over Base so they wrap it for you. So yeah, that's that, right? So Coinbase Wrap BTC is actually wrapped Bitcoin. So you can borrow against the value of Bitcoin if you don't want to get out of Bitcoin using wrapped Bitcoin. Otherwise, much simpler if you just want to use ETH as well. But again, then you hold ETH and you may not want to hold ETH. In any case, that's how it works. We're going to borrow against ETH. So on the Base market, I'm going to click ETH here and I need to borrow against ETH. So what I'm going to do is put some ETH into the platform first, and I'm going to supply that because I've got some ETH here. In order to borrow against ETH, I have to supply it and put the collateral on the system first. So let's go ahead and supply. I'm going to press supply here. We choose an amount, so something like this. It's going to ask me, do I want to put this on? I'm going to press supply. You can see the gas fee here. This is the supply APY. Because I'm supplying ETH to Aave, I actually get this interest rate for supplying the ETH. That's going to come off of my borrow rate, which is pretty good. So you can see the health factor here, no problem, supply ETH. My wallet is then going to go ahead and actually pay for this transaction. It says, do you want to interact with Aave? I'm going to say yes. You can see everything here. I'm going to sign that transaction and confirm. What I'm doing is sending ETH out of my wallet and putting it into the Aave smart contract. Now I have this ETH on the platform as collateral that I can borrow against. Now that I've put some ETH on the platform, I can use the value of that to borrow against. So I'm going to go to dashboard here. These are my suppliers. This is the ETH that I'm supplying. This is the APY because I'm actually putting it in the lending pool. So I'm getting that for putting the ETH on the system. Yes, I do want to use it as collateral and we can go ahead and borrow against it. You can see I've actually got a borrow here already, which is from a previous tutorial where I didn't pay off the exact amount of the loan. I've got like a fraction of a penny left racking up interest, but that will keep a fraction of ETH as well to pay that off. So, you know, it's nothing, right? It's under a penny. So what we want to do is go ahead and borrow. So we can actually go to the markets and then choose the borrow details here, or just go to dashboard, go down assets to borrow and click on USDC. That's the stablecoin that I want to borrow here. So I'm going to press borrow. And how much do I want to borrow, right? So let's say $10. And then you can see health factor, no problem. Borrow USDC, borrowing. And that will have to go through with a transaction. So I have to sign that, check all of the details. Yes, no problem. Sign transaction, pay the gas fee. So what I'm doing here is borrowing that dollar or those dollars against my ETH as collateral. Now I've taken that loan, you can see my debt is the amount of the loan. I took a $10 USDC loan. I have this debt here of $10 that's racking up interest at the current APY of 11.81% minus the 1.9% that I'm getting for my ETH. Those dollars have been deposited into my wallet. So I've got this debt on the system, which I can repay. But if you look at my wallet now, I had 50 USDC in here before, and right now I have 60 USDC. So that $10 is deposited into my crypto wallet. I can do anything that I want with this. I can go and buy a meme coin with it. I can take that USDC, put it back onto Coinbase or Binance or Kraken, trade it for fiat currency, and then withdraw it via the banking system into my bank or anything else that I want. That is my USDC to do what I want with. The reason being is that Aave gave me that loan against this collateral, which is more than the value of the loan. So if the value of my ETH goes down, they will liquidate me when my loan to value gets to around 75, 80%. We want to repay this now plus the interest. So we go to repay. What we do is press the wallet balance. The reason being is because I am paying back the USDC plus the interest that has accrued already. If you want to pay back using ETH, you can do. They may liquidate some of your ETH and pay that back. But I'm going to pay back with wallet balance because I've got some USDC already to pay for the loan plus the interest. So I'm going to press max like this, press repay. Then you go through with another transaction, you pay a fee. Small fee on base, I think it's like 5 cents or something. So I'm going to sign this transaction, press confirm. That pays back the USDC plus the interest. Now, because of the time difference here, like you saw, there may be a tiny fraction, like under a penny worth of USDC that I actually don't pay off because the interest may have racked up. In any case, that doesn't matter. You will never go into bad debt. So, okay, close. Okay, then as you can see, nothing borrowed. So all my debt paid off. And then my ETH back here, I can withdraw that from the platform as well. Withdraw. The amount that you want, press withdraw there. You want to take that out of supply. And so you can do that if you want to go ahead with that transaction. Press approve, withdraw, that withdraws the ETH back into your wallet. And then from there, if you want to send that ETH back into your exchange or anywhere else, keep it in your wallet, you can do. Both CeFi and DeFi platforms have their own set of risks, so please be aware of that before taking any loans. And I'll leave some other helpful videos down in the description, plus the deposit bonuses to the exchanges I use down there as well. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.